Hello students, in the present lecture we are going to discuss deductions from gross total income under chapter 6a. In India there are 5 heads of income. Number 1, income from salaries. This head of income has deductions. The total of salary income is termed as gross total income, and after deduction of that head it is taxable income under the head income from salaries. Another head of income is income from house property. Third one is profits and gains of business and profession. Fourth, capital gains. And fifth, income from other sources. Though these are the 5 heads of income, each head has its specific deductions. After that, the total of these 5 heads, or sometimes less than 5 heads, is termed as gross total income. And there are deductions which are allowed under section 80. After making deductions of 80, the coming income is taxable income, total income, chargeable income. The chapter 6a of the Income Tax Act 1961 provides the certain deductions which can be claimed by the assessee in computing his total income. Total income is equal to gross total income minus deductions under section 80. These deductions under section 80 are given in chapter 6a. Gross total income means the total income under all heads of income. All heads of income means 5 heads of income, computed in accordance with the provisions of the Act, section 80B, clause 5. The gross total income is to be arrived at before allowing any deduction under chapter 6a. Gross total income means the total income of 5 heads. Before 5 or less heads, before allowing any deduction under chapter 6a, and after setting of unobserved losses, depreciation of the earlier years. Section 80 to 80U specifies the deductions to be made from the gross total income. Deduction under section 80 starts from 80C and ends on 80U. The purpose of these deductions is to encourage saving. The main purpose of giving these deductions is encourage savings among the assessee, industrialization, foreign earnings, and assist taxpayers in meeting their essential expenditure. The idea behind giving deductions under section 80 is encourage saving, industrialization, foreign earnings, and assist taxpayers in meeting their essential expenditure. Basic rules governing deduction under section 80C to 80U. We know that 80 deduction starts from 80C and ends on 80U. For getting any deduction under section 80, the following are the basic rules. The aggregate amount of deduction specified in section 82 in section 80C to 80U should not be exceed the gross total income. If an SEC gross total income is rupees 10 lakh and the amount of deduction under section 80C 11 lakh, it means that here amount of deductions is more than gross total income. So kindly remember that the aggregate amount of deduction specified in 80C to 80U should not be exceed in gross total income. These deductions are allowed only the SEC claims them. That is very important. These deductions are allowed only SEC claims them. If the SEC fails to claim any deduction, no further deduction will be allowed. Where the deduction in respect of certain income is to be allowed, where any deduction in respect of certain income is to be allowed, it has to be calculated with reference to the gross amount of income as reduced by any allowable expenditure of this income. After receiving income, consider the expenditure allowed for that income, and that expenditure is to be deducted from the income, and remaining amount is taken as income. Where association of persons or body of individuals is entitled to deductions under 80G, 80GGA, 80HH, 80HHA, 80HHV, 80HSC, 80HHD, 80I, 80IA, 80IB, 80J or 80JJ, a member thereof cannot claim the same deduction in relation to share of such member in the income of the SEC. Association of persons or body of individuals, they are eligible for getting these deductions. Shares received or claim of member received to that member for that purpose, consider that matter. There are three types of deductions under section 80. We know that deductions under section 80 are allowed from gross total income of an SEC. Gross total income means the total of 5 heads or less than 5 heads. There are three types of deductions under section 80C. Deductions in respect of certain payments. It means that payment made by an SEC for taking life insurance, for paying educational fee of students, for taking NCC certificates, national savings, for taking NCC national savings, NSC national savings certificates. It means that payments made by an SEC termed as deduction in respect of certain payments. On the other hand, deductions in respect of certain incomes. There are certain incomes received to an SEC. For that income, specific deductions are allowed under section 80 and other deductions. Hence, here we are focusing three types of deductions from gross total income under section 80, namely deductions in respect of certain payments, deductions in respect of certain incomes, and other deductions. Firstly, I would like to explain deductions in respect of certain payments. Under this head, some deductions are coming. Some deductions are coming under incomes and other deductions. So, presently we are focusing deductions in respect of payments made by an SEC. Number 1. Deduction in respect of specified savings from income under section 80C. This deduction is given to encourage saving habits among the SEC. Payment made to the undermentioned scheme is treated as qualifying savings. Following sums paid or deposited. The amount paid or deposited by an individual or a Hindu undivided family at any time during the previous year qualifies for deduction from his gross total income under section 80C. Deduction under section 80C is allowed to an individual and a Hindu undivided family. That is important. This deduction is given in order to develop saving habits among taxpayers. So, however, the aggregate of this sum should not be exceed rupees 1,50,000. It means that up to rupees 1,50,000 payment or deposit is exempted. Suppose a person paid or deposit amount rupees 1 lakh, he is eligible to claim deduction of rupees 1 lakh under section 80C. Another example, a person or an individual made payment or deposit amount of rupees 5 lakh to the under mentioned scheme. Though he paid 5 lakh, but he will receive deduction maximum of rupees 1,50,000. So the following payments are treated as qualifies for saving. Life insurance premium. Life insurance premium paid by an individual of own life, spouse life, children life, parents life. A Hindu undivided family had taken life insurance of members and premium paid for it is allowed here. Contribution to Provident Fund, to which Provident Fund Act 1925 applies. it means statutory provident fund. Contribution made to that fund is treated as qualifying saving. Contribution to public provident fund PPF, that is treated as qualifying savings. Contribution made by an employee to recognized provident fund. Contribution made by an employee to approved superannuation fund. Deposits in national savings certificates 8th or 10th issue. Subscription to LIC mutual fund. Contribution to unit linked insurance plan ULIP 1971 of UTI. Contribution to annuity plan of LIC. Payment to deferred annuities other than LIC. Deductions made by the government towards deferred annuity or making provisions for his spouse or children not exceeding 20% of salary. Subscription to any units of specified mutual funds. Subscription to notified deposit scheme of the National Housing Bank, or contribution to notified pensions fund set up by the National Housing Bank. Contribution by an individual to notified pension fund. Deposits in housing finance companies or authorities. Any sum paid by an individual as tuition fees. Payments for the purpose of purchase, construction of residential house. Subscription to equity shares and debentures approved by the board. Board means Central Board of Securities Exchange Board of India. Any sum deposited in notified bank deposits with scheduled banks not less than 5 years. Subscription to bonds of NABARD. Deposits under Senior Citizen Savings Scheme. 5-year time deposit in post office. Subscription to equity shares and debentures of infrastructure development companies. From this we learned that contribution or payments or deposit made by an individual or a Hindu undivided family to under mentioned scheme up to rupees 1,50,000 allowed as deduction under section 80C. Second deduction. Deduction in respect of contribution to certain pension funds under section 80CCC. 80CCC. This is deduction in respect of pension funds. An individual assessee who deposits an amount to keep in force a contract of annuity plan of Life Insurance Corporation of India or any other insurer for receiving a pension from fund established under section 10 clause 23 AAB allowed as a deduction of the amount deposited or rupees 1,50,000 whichever is less. In order to get pension in future, any member from society can contribute that pension fund planned or designed by Life Insurance Corporation of India or any life insurance company. The intention behind it to get pension for future if a person will become eligible to work. So this is the pension plan developed by LIC for the whole society. There is no need to follow the restrictions that are governed under the head salaries. But here we should take into account this deduction, this amount of contribution should not be rupees 1,50,000. Hence, maximum contribution allowed per year or previous year up to rupees 1,50,000. But when annuity plan terminates, the amount withdrawn or received as annuity is taxable in the year of withdrawal. When annuity plan terminates, the amount received on that account is taxable. Moreover, a deduction in respect of such contribution should not be allowed under section 80C. In short, the aggregate amount of 80C, 80C qualifying savings, 80CCC contribution to pension fund, 80CCD that is medical insurance shall not be any case exceed rupees 1,50,000. It means that aggregate amount of three deductions, that is 80C, 80CCC, 80CCD shall not be exceed rupees 1,50,000 in any case. Then third one, deduction in respect of contribution to pension scheme of central government under section 80CCD. Firstly, note that there are three deductions. In the present lecture, we are discussing three deductions. First, deduction in respect of payment made to various schemes, that is deduction under section 80C for qualifying savings, 80CCC for payment to pension scheme developed by LIC. Third one, deduction under section 80CCD, that is contribution to pension scheme developed by central government. It means these three deductions are related with savings, that is termed as qualifying savings. If an SEC made, SEC means here an individual or a Hindu undivided family, the payment made by them to this scheme, the amount contributed or payment made or payment deposited is qualifying saving up to rupees 1,50,000. If an individual SEC employed in central government service on or after 1st January 2004 has deposited any amount in his account under the pension scheme notified by the central government, he shall be entitled to claim following deductions from gross total income. A. Employee's contribution to notified fund not exceeding 10% of salary. Employer's contribution to notified fund not exceeding 10% of salary. We know that after 1st January 2004, existing pension scheme has been cancelled by the government. So another alternative is given by the central government, and this deduction is allowed to employees working in central government. And central government has developed a pension scheme for its employees, and the amount deposited for that pension scheme after 1st January 2004 onwards, an employee is eligible to get deduction to the limit of 10% of his contribution to pension fund and 10% of contribution made by employers to that scheme. It means that an employee can claim up to 20% of salary as deduction, but limit is that own contribution should not be more than 10% of salary, as well as employee's contribution should not be 10% of salary. Salary for this purpose includes basic salary plus dearness allowance if the terms of employment so provide, but exclude all other allowances and perquisites. Here salary means total of basic pay and dearness allowance. Moreover, a deduction in respect of such contribution should not be allowed under section 80C. Any other individuals assist, it means that non-government employee, the contribution does not 20% of gross total income. This is national pension scheme developed by central government for its own employees, but any other employee or individual is contributing for pension scheme, the contribution of that person should not be exceed 20% of his gross total income. Hence, we discussed here three important deductions. First, deduction in respect of savings under section 80C. Deduction is in respect of pension scheme of LIC under section 80C. Deduction in respect of pension scheme developed by central government, deduction under section 80CC. And fourth, aggregate amount of deduction under section 80CE. That is very important. The aggregate amount of deduction allowable under section 80C, 80CCC and 80CCD should not be exceed rupees 1,50,000 in any case in previous year. It means there is upper limit of rupees 1,50,000 in respect of three deductions. It means that aggregate deduction under section 80C, 80CCC, 80CCD should not be more than rupees 1,50,000. So in this lecture we learned gross total income, what is meant by gross total income, what is meant by total income, what are the deductions allowable, that is under section 80C. What deductions are allowable under chapter 6A. That deductions are allowed if conditions are fulfilled from 80C to 80U. In this lecture, we focus the three deductions: 80C, 80CCC, 80CCD, and the aggregate amount of these three deductions should not be rupees 1,50,000. In this way, I am concluding my lecture here. Thank you for patiently listening.